on this Tuesday afternoon. It's become a regular Tuesday afternoon meeting place for Good Forsure and their clients. So thanks to our existing clients for joining us. We've got a great guest speaker this afternoon to help us get a little bit of a better understanding and perspective on where more, how can I say, boutique asset managers are positioning themselves. So we've got Ryan Jameson from Fairtree Equity or Fairtree Asset Management to talk to us this afternoon on how the Fairtree Equity Fund is positioned and are taking positions currently. So while we just wait for a couple of people to still join us, please have a look on your screen. There's a call to action button. So if there's someone that needs to schedule an appointment with one of our advisors, existing client or new, doesn't matter, please make use of this functionality where you just click the link. It takes you to a page. Select the meeting request, the type of meeting, and the advisor you'd like to speak to, and we'll be in contact. You can even schedule the date and time that suits you, and we'll sort you out. We'll set up a Zoom meeting or Skype meeting or just even a phone call where we can just chat to you and give you a little bit of peace of mind or help you with a couple of questions. Now there's 2 or 3 people still joining us. I'm just going to bring Ryan on the screen here, and then Ryan, I hope you're ready. Just while I bring him on screen, please be on the lookout for our ads or our invitations. We have a nice webinar on Thursday evening, which one of our specialists in Good Forsure, Chris Swanepoel, will be presenting. He'll be presenting especially regarding income protected benefits and how they work and how they come along. I know this is an investment group or investment seminar group, but please, if you can, join that webinar. We've got Ryan here. Afternoon, Ryan. How you doing?
Good, thank you. And you?
I'm doing very well. You know what? Like we always say, we keep it sweet, we keep it short. Thank you very much for joining us and taking time out of your schedule to talk to our clients and new clients. I want to get rid of myself. I'm going to hand the stage over to you, and we're going to have some Q&A. So during the presentation, people will be typing questions on the functionality, and then at the end, you'll see it at the bottom of your screen as well. You can just start answering them, and as you answer them, I'll take them off screen, and we can give some clarity to the clients. Once again, thank you very much. We really appreciate it, and everybody that's joining us, thank you, and I hope this adds value.
Okay, let's share screen and get started. Are we in the right place? Can we go from here?
You're 100% in the right place. We can go from here. Thank you.
Okay, super. Firstly, just a word of thank you from my side, from Fairtree's perspective. It's great to be able to talk to you and talk to clients this afternoon. You're right, we'll keep it brief. We'll deal with a few questions and talk about the equity fund overall, and probably go through a few slides. I'll make a few comments per slide and then open it up for maybe some Q&A toward the end, if that works for you. Right, maybe just to kick things off, you raised a good point about boutiques. So I thought I'd just color things in a little bit around Fairtree and just who we are. I'm not going to spend too much time here, but what you can see from the slide is that we've been around for a little while, dating back to 2003. It's really been a long way in the hedge fund world. Over the last sort of 9-10 years, we've got into the traditional unit trust or long only world. But we've been going for some time. We've got a good number of investment professionals and staff members, and we currently run about 70 billion in assets. So we certainly aren't massive, but we aren't as boutique-y as some of the smaller boutiques may be. I mean, 70 billion is still a sizable chunk of assets to run across a number of capabilities. Just an interesting point with regards to our client base, around 40% of our clients are in fact offshore or foreign clients or foreign investors. So we see clients from the Middle East, the US, Europe, the UK, and we run strategies for clients who are in fact foreign institutions. So, you know, when we look at our unit trust suite and our solutions that we build in South Africa and for our South African clients, one of the cornerstones of doing so was that we want to bring institutional quality to each and everything that we touch. And those unit trust funds are simply a function of taking this institutional quality and thinking into a unit trust that South Africans can trade in and out of. So that's a snapshot of who we are. Maybe just to color it in a little bit, I mean, some of our peer group have 600 billion in assets, even north of 600 billion. Perhaps the Corona crisis has taken care of some of that asset base, but it's been a growth and a journey for us that we are very, very pleased with, and we've come a long way, I think, in a relatively short period of time. Right, so I thought I'd spend the afternoon putting some context to our fund positioning. So getting us to the sectors and the shares that we invest in. But I thought I would do so by just looking through global markets, the COVID-19 impact, how monetary responses have been, central bank responses, where equity markets have been, and really just get us to that positioning around sectors and stocks. The one comment I can make is we came into the year after a very good 2019, feeling that we were quite well positioned for the year ahead. And COVID and Q1 came along and changed that thinking very, very quickly. We had a good 2019 calendar year return. We were positioned in a very similar way from December to January this year, and we'll talk a little bit about that. But we had to change our thinking and get quite flexible quite quickly. And I think that's also one of the points about a boutique, is to react to change. So when you have funds and fund sizes and positions in liquid parts of the market, you need to be able to be flexible and nimble and be able to execute trades quite quickly. And I think that's what the boutique managers can certainly do. Right, so let's get into a little bit of track record, just 2 slides on where we've been then. If our track record has been over the last couple of years, this is just the snapshot of calendar years of our relative performance. The orange is the times during which we've outperformed our benchmark. So the blue color represents the benchmark return. Anything in orange represents benchmark outperformance. And I think we're very proud of the fact that you can see we've done so each and every calendar year. So there is an element of consistency. I certainly wouldn't pay too much attention to 2019 for the market or the benchmark to do 6 or 7%. And for us to do 15% above that benchmark isn't something we set out to do. I made the comment just now that we were positioning our portfolio for 2019 and 2020. And in that thinking and in that positioning, we had large resources positions, precious metals, platinum, gold, and I'll talk to that a little bit later on. And that really, really was instrumental in that phenomenal excess return over the benchmark. But as you can see from the chart, over time, it's not that we set out to do that. Our positions and our trades just were in our favor, and 2019 was a phenomenal year for us. But I think you can see the trade pattern over time. I spoke about institutional quality and getting institutional quality into our South African client base. Our foreign investors have the same mandate, the same investment management team, and it's something that we look to be very consistent around. Here we are looking at Q1, and this is the track record of the fund away from the column graph just into a line chart, and you can just see the drop-off in Q1 of the benchmark and, of course, the fund. The uptick is a very, very strong April, and we'll talk about this positioning around resources and gold, precious metals, but really we came back really strongly in April. We got carried out in Q1 in March with a number of other players, and all assets for that matter, as we'll talk about later. Even a perceived safe haven asset like gold saw the price fall, and platinum prices fell, palladium, rhodium, and we weren't spared either. But we came back around 29% in April, so we put back a lot of the losses just in 1 month, and we're looking to build on those recoveries as we position the portfolio going forward. So that's a line graph and a column chart of just where we've been, a little bit about Fairtree, and probably best to now start unpacking the macro and this impact that we've seen with COVID-19 and what it means for our position. So maybe just to kick off on the first slide, and just probably the last two drawdowns are of note. The first drawdown you can see around the mark of 2010, that represents the GFC, or the global financial crisis. And you can see the corona crisis in 2020, just how sharp that drawdown was relative to drawdowns of the past. So this drawdown is representative of the Dow Jones, so it's a US equity market experience going back over 55 years, and it ranks with the most severe that we've seen. You know, markets had fallen 35% very, very quickly. And, you know, it was you almost had very little time to react, even to change and position portfolios while the market was falling as quickly as it did. If you have a look at the speed of that decline, I spoke about markets falling 35%. If you just have a look at that gold or orange color where it represents the COVID drop in 2020, you can see markets have fallen from 100 to, call it 65, representing the 35% fall. You can see it's done so in about 30 days. If you follow the horizontal axis, it actually sets out the number of days that markets have taken to fall. So if you just have a pick one, if you look at the GFC in 2008, you can see just how long the GFC took to fall 35%. It took over 240, 250 days to give you the same level of fall or depreciation, but over a much longer period of time. The corona crisis and COVID-19 sorted markets out in Q1 very quickly. You didn't have this slow, gradual depreciation and fall in markets over time. It fell very, very quickly, as you can see from the chart. So that's markets just in a nutshell. I don't want to spend too much time on Q1 and what went on. I think you've read enough and there's enough doing the rounds in terms of overall information. But I'd like to start moving into how responses are taking place and what the economy and what the macro environment is starting to look like. You know, everyone's starting to talk about V-shaped recoveries and U-shapes and solutions and vaccines, and all these things are forward-looking. And you know, none of them are crystal clear, and markets are still trying to find their way around. And for those of you that have bought shares, perhaps even in February and March, or even in April, you've seen shares go up and they're trading in this band, but there are these large swings and markets are quite volatile, even at this stage. The volatility isn't what we saw in March, but there is overall a level of volatility and markets just going back and forth with big trade days being registered with a little bit of uncertainty as to where to from here. And we'll have a look at that in the next couple of slides. Right, starting with global monetary easing and central banks starting to get involved. We've seen banks cut rates aggressively. Further rate cuts are arguably limited because rates have fallen so low. You know, we'll talk about the South African experience, but if you're looking at negative real yields or almost 0% yields in central banks or in policies around the world, there's not much further you can go. Following on from a very low cutting cycle, you start embracing things like QE or buying bonds through quantitative easing for liquidity. But just this slide and these two charts capture the level of aggressiveness of how central banks have come along and cut rates globally to try and stimulate the economy. They're trying to create stimulus around the consumer and economies in general. To the right-hand side of the screen, it's the number or the percentage of central banks that are in fact easing policy. And you'll probably see that trend line pick up as central banks embrace on monetary easing as far as they can go, as far as they are willing to cut interest rates. And then they start relying on government spending and fiscal packages and trying to get economies underway as openings start taking place. I touched on fiscal stimulus, just a forecast of projected stimulus of where we are currently. And if you look at the forecast, the column graph second from the right on the chart, it actually is so much and so significantly more than what we saw in the GFC. You know, we have this not just lower interest rate environment where central banks have come along and are cutting rates in order to stimulate economies, you've got governments now embarking on these stimulus packages. Whether they are looking at packages worth 10, 11, 19% of GDP, they are certainly coming along to play. And a lot of people have argued that this rate cutting and stimulus packages are actually preventing the market from finding its own true level, because already the market's starting to look forward and saying, if the stimulus packages are underway, and already if we're seeing some signs of opening, is it not too long until we get things underway again? And they're trying to time this by forward looking, and you're seeing markets going up. So you've seen this bounce off these March lows. And I think the question is, how high does that bounce go? No one is sure. And also, does it revert back to some of the March lows that we saw? Does it retest those lows? And with the level of stimulus, there's a level or a school of thought that's saying perhaps this time with the stimulus and the easing around monetary policy, it's provided enough as a buffer from stimulus packages for markets to start thinking about looking forward. But I think time will tell. This is a very interesting chart of the US conditions. And if you look at the US GDP, 2/3 of US GDP comes from the US consumer. That's how important the US consumer is. So if you bring that back relative to closing economies and then gradually opening economies, for the US consumer to start spending and being 2/3 of US GDP, you can see the pressure that's going to be on these growth numbers. But what this graph shows is, it does show in gray that manufacturing is going to be under strain. Manufacturing is going to be under stress. You can see the forecast dip all the way through the 2020 calendar year. But what it's also showing is perhaps growth tax isn't the right word. Maybe it's support for the US consumer, because that level of support for the US consumer in orange has ticked higher as a result of mainly of three things. The first is a strong dollar. The second is an exceptionally low interest rate. And the other is the oil price. So you've actually got a stimulating package that actually plays through to individual consumers, that is almost acting as a form of stimulus on its own, and that's a lower petrol price, lower oil prices, and the benefit that consumers have experienced as a result of those two things. So you've got these three things really benefiting the US consumer. So I think the point would be, if and should a vaccine be found quite soon and come online and things start normalizing as best they can, you actually would find a very sharp recovery from markets, if that is the case, because they were actually well positioned coming into the crisis in sort of January, February, the US consumer. You've got this stimulus, you've got the oil price collapsing, and you've got these areas that are just supportive of the US consumer being 2/3 of US GDP. I spoke about gold, and I mentioned that we've got a gold position, and we've held a gold position for some time in our portfolios. In fact, we've actually had a resources in gold, platinum, precious metals play in our portfolios for some time. But this is quite an interesting, I just want to delete something on my screen. This is quite an interesting chart that just compares where we are now with 2008. So it takes the US S&P 500, so a broad-based proxy for US shares. And if you start on the left-hand side and you just follow orange. Orange is the S&P 500. You can see the pressure and the stress through the global financial crisis back in 2008. And even an asset like gold, if you can just follow the blue line, staying on the left-hand chart, if gold went from around $1,000 to about $600 at the same time. So you again are questioning, hang on, I bought a safe haven asset, and yet the safe haven asset is falling with all the other shares or markets around the world, and the gold price is falling, which happened in 2008. And to the right, we'll look at now, it's happening in 2020 as well. But what you can see is the gold price staying on the left, hitting that bottom of around $600, $700 an ounce, and then moving quite sharply all the way through 2008, 2009, and really getting into some serious uptrend as gold prices picked up off those bottom levels. If you move across to the right, it's not dissimilar in terms of what we're seeing now. gold is perceived to be this safe haven, and it also fell during 2020. So we were quite concerned. We had and have positions in Anglo Gold or in Harmony, for example, and not just the share prices, but the actual gold price was falling. So you had this double whammy coming through. We are certainly of the view that the gold price will bottom and start moving, and probably 4 or 5 months before the equity market settles and starts turning in a dominant fashion, edging higher. And you can see that gold's already come off those lows. The gold price did follow blue again on the right-hand chart. It has found some deep resistance after March, and already it's climbed higher, along with things like rhodium, palladium, platinum, etc. And we're finding a very similar experience. It felt in March there's just nowhere to hide. You're looking to position the portfolio against share prices falling. You're holding safe assets, and the safe asset prices are falling with your shares. And it was a very, very difficult time. In fact, a number of investors that held gold actually sold gold positions for liquidity in funds where drawdowns or withdrawals were taking place in order to fund positions. We spoke a little bit about gold, and what of course is very supportive for gold is these lower rates, lower bond rates, lower real yields are very supportive of the bond market, of the global, of the gold market going forward. And so what I've shown here is I've just got the global real yields in the blue column graphs, but the black and orange graphs are global bond yields and CPI. And these are incredibly low, and these levels aren't necessarily going anywhere in a hurry in terms of the packages and the stimulus being put into the market currently. And this is again supportive of gold. If you think of gold and precious metals and the support that this environment is creating for gold, and just thinking of the previous slide and the two charts that we saw, thinking back to 2008 and March 2020 in terms of upside opportunity for precious metals and gold. Right, so maybe just bringing it home a little bit and just to talk to our South African equity market and some of the responses taking place here. And then I just want to get into the fund positioning and some of the shares that we are holding, even in a rather concentrated portfolio in the depths of what we're working through in markets. Right, so I think there's a very, very important condition that's playing out in South Africa, and it's not just South Africa, but for anyone who has a export of something like a precious metal and they are net importers of something like oil, the terms of trade for someone like South Africa in this situation they're quite profound. If you think of the terms of trade that we currently have, we have precious metal prices going up, and they've rebounded strongly from the March bottoms, which we spoke about. So precious metal prices are going up, and they are arguably 35% of our exports. We are a large consumer and importer of oil, which is almost a fifth of our imports. So call it 17% of our imports. The terms of trade that our mining companies can now operate within are just displayed on the screen. You've got this input cost of oil falling, and you've got very, very high and elevated precious metal prices poised to go even further. And those terms of trade are very, very good for our mining companies. And it's been a long, long time since the mining companies have actually been in this position. And if you think about the mining companies, sure, they don't have the way they used to have in terms of contribution to GDP. But if you look at the earnings that these mining companies can start printing, even if spot prices stay where they are, so if current spot metal prices stay where they are, and these mining companies start printing great earnings coming on stream, there are really three areas that'll impact. It'll impact on the labor force. It'll mean obviously more and more of labor can be employed and be engaged in the mining sector. It impacts all the service companies. So all those service companies that are affiliated to mines and mining, they certainly have a level of work that they wouldn't have necessarily had before. And also very importantly, it talks to tax generation. So the more and more money these miners are making, the tax revenue from those mines certainly will help our government balance sheet in terms of picking up the overall tax revenue from printing these great earnings numbers. So the terms of trade for the miners are very, very positive. If precious metal prices keep edging higher, and they don't need to fly from these levels, but if it's around spot or higher, and oil prices remain suppressed, the terms of trade for the mining companies are significant. Just bringing it into South Africa consumer speak. I spoke a lot about oil, and we've spoken about oil prices falling and our interest rates being lowered or dropped. So far this year, we've had 225 basis points. So rates have fallen 2.25%. And what this does is it tries to capture on one slide the repo rate, the South African inflation rate, and the oil price change, but what it also means for our real economy. So you can follow the black line. The black line just traces the repo rate, and at 2.25% already cut this year, there are schools of thought that talk to a further 50 and a further 50 after that. So there could possibly be another 50 or 100 basis points of easing. So the repo rate falls further, as does the prime rate. The point about grey or black staying on the first point is that those rate cuts will unlock about 80 billion in the South African real economy. Okay? That's the first point. Following orange or gold, the drop in fuel and petrol prices and fuel prices also, for the benefit of consumers, mean they pocket between 50 and 70 billion. So these two combined forces of lower interest rates and this drop in fuel or oil prices as this incredible stimulus package awaiting consumers. Now, of course, that doesn't mean it's going to be turn a light switch and everything's going to be okay as we open up. There is still going to be pain to be had as we open up, as we move into this next step, next level. And as the economy starts finding its feet and starts getting into a zone, I can't even say that it looks normal, because already we've been marked down by the IMF, we've been marked down by Moody's, and the COVID pressure on our growth numbers is going to be significant. But the support for the consumer, which also has a large impact on the upside and economic growth, is really there for us to start benefiting from. Inflation's at 4%, 4.1%. And although we're going to go through this period of sluggish economic growth, there is a story growing for the South African consumer and overall for policymakers. If I just think back to the points I made previously about the miners and tax revenues and labor force and service companies, there's a lot of, I don't want to use the term good news because it's so difficult to find good news in what we're working through as a community and as a country. But there certainly is this groundswell of support lingering and just waiting to be unleashed when we systems go. I've spoken a little bit about interest rates and inflation. I'm not going to dwell too much on this slide. You can see the repo rate and just how it's fallen. I made the comment that there is a school of thought that suggests another 50 or even 100 basis points of cuts to come. That certainly could be the case. We've already had 225 points already. And inflation is well under control in South Africa as well. There's no growth to speak of that's going to drive inflation higher. The rand has slipped, absolutely. It has depreciated. It's come back a little bit from the lows that it's tested. But the oil price and fuel price will act as an opposite pull on where the rand quickly disappeared to in February and March. So the rand is in fact close to historical lows. As you can see from the chart, it's just about where it's been over time. This chart goes all the way back to the year 2000. It has come back from its levels that it touched on, but you know it's in a position where perhaps foreigners now look at South Africa after the downgrade. You know, after we're no longer investment grade, we're now in the high yield market, but still with the entry point being the rand and our attractive yields or rates on our 10-year bonds, for example. It still puts an attractive real rate down for foreigners thinking about buying instruments or assets in South Africa. If you have a look at attractive real interest rates, and these are 10-year yields, so 10-year bonds in South Africa, and you consider where the exchange rate is, you know, whether it's 18.3 or 18.5 or 19 or 17.8, and it hovers in that area, you know, it's still a cheap entry point for foreigners coming in. So although we might not be in WIGBI and we've been downgraded and we've seen bond flows, we're now in the high grade market, high yield market, and we'll be open now as a market and as a as an asset class to a different set of investors. And we're looking quite attractive relative to some of the names that you can see on the screen as far as real interest rates are concerned. Right, and then maybe just to close for a minute or two and just talk about our fund positioning. As I mentioned, we run assets for a number of institutional clients, and our unit trust funds and our equity fund in South Africa is the same institutional quality. It just provides an entry point for South Africans to invest with Fairtree. Just one important thing that we do within the fund, which I didn't mention up front, is we don't invest in foreign shares. So what I mean by foreign or global shares, Microsoft, Google, Apple, we don't invest in those counters. We invest in stocks or shares listed on the JSE. So we appreciate the fact that of the top 50 shares listed on the JSE, 70-odd% of their earnings are in fact derived offshore. So sometimes they really behave like offshore companies, but we keep our investment mandate limited to companies listed on the JSE. So when you look at other equity funds or other equity fund managers, you can often see these names, whether it's Harmony or Anglo or Mr. Price, etc. But you'll often see them relative to or next to Microsoft, Google, etc. We keep our investment mandate limited to shares listed on the JSE. And what we do in doing that is we look at 4 main sectors of the JSE. We look at South African Inc. or SA Inc., which really accounts for your banks, life insurers, retailers. We obviously look at the miners and the resources sector. We look at offshore consumer growth, which is Naspers process, for example. And we also look at offshore defensives, which you don't see on the screen in the sector split because we don't hold any. And offshore defensives are typically things like Richemont, BAT, Anheuser-Busch, where you get the strong rand component from these defensive shares should the rand weaken significantly in a normal environment. But we don't invest in that sector yet. But what we do is, being a boutique and being quite active and flexible around how we run the portfolio, we look at a macro lens through these 4 sectors. And then also from the bottom up, we start building a portfolio, and we look at the sizing of the names and the portfolios that we build into our equity fund. And we look for the combination of this bottom-up share-specific play alongside these sectors. And we operate all then within the JSE listeds, as opposed to venture thing we probably know too little about. We would argue there are other, especially with institutional clients, as I mentioned, a number of those institutional clients have probably better, firmer, and stronger views on the likes of US stocks than we're going to have from our office in Stellenbosch. So we really play to our strengths, and we invest in what we know as best we can in order to generate that institutional quality. Just to the right, I think you're quite familiar with most of those names. I certainly hope you are. You can see a strong, if you look at both charts, in fact, or both graphs, you can see a very strong positioning around platinum and gold miners, diversified miners. We have a fair position in SA Inc. We are starting to look into SA Inc., including the SA property sector. Some of the banks, although we do prefer some of the credit retailers, as you can see, Woolies, Truworths, and Foschini. We have some life insurance, 1 or 2 banks that we have looked at. But you can see the dominance and the positioning is around this resources story. Gold, precious metals, inside some of these businesses, it'll be an upside for precious metals, platinum, palladium, alongside the gold story. And we certainly think precious metals and gold are very well positioned from these levels, for the reasons I mentioned briefly through the presentation. Should that change, I think the next position in our portfolio will certainly be to not reconsider, but just start thinking about being more constructive on things like SA retail. You can imagine in a very low interest rate environment, the consumers now starting to get a little bit more confident, stimulus packages and the like coming to the front, an economy that just starts moving in the right direction, and people perhaps are more confident to go out and spend money. the credit retailers and retailers themselves will probably be in a better position than the banks. But then you start looking into the banks and the insurance companies as things improve, and that'll probably be as a consequence of reducing some of the miners in order to pick up that exposure down the line. So I think I'm gonna leave it there. If I could, I don't know if I should keep my screen stop sharing in order to take Q&A, because I might reference a few slides. How should I deal from here?
Ryan, yes, let's quickly have a look at the questions. I see there's no particular questions, so I assume that the presentation you did was quite insightful, and that there's no Q&A. Let's give it a couple of minutes or a couple of seconds for people to ask questions if they want to ask questions. Ryan, thank you very much. While everybody's going on to the Q&A, we really appreciate your time, and I think it's given us a better understanding on the position in gold and the position in resources, and this is one of the reasons why we have Fairtree equity in our portfolios. We can really see the way you guys look at it, and there's a good reason we hold position for our clients. And I see there's one question. Yeah, you can see it there. It's just a question. It says, what is your view on Sasol?
That's a good one. We hold no Sasol in the portfolio. We think the business is under stress, with a number of factors and issues coming Sasol's way in the not too distant future. We exited our Sasol position, I'm not exactly sure of the month, so I'm going to say the middle of 2019. So we didn't time it perfectly. We took some of the downside, but we just think there's a lot of stress in the business and a lot of stress in that price. It's been behaving quite erratically. You've seen it fall and rise all over the show. So it's probably a trader's dream at the moment. It's not something we are looking to hold. We've held it in our portfolio, make no mistake. We just don't think we'd be a buyer over the next year or two. I think it's got a lot to sort out. And it's a zero position in our portfolio and has been almost for a year. I'd be a bit off if I had to give you a month, but for some time we've held no Sasol exposure.
Okay, great. I think that on quite significant. I don't think there's any more questions. I'm just going to quickly come back on here, and thank you very much once again from our side for joining us. And like we say to our clients, we'll be sharing your presentation with them, and at least they can see what their money's doing and where their money's positioned, how you guys are taking positions. Thank you very much. I appreciate your time.
No, anytime. It's an absolute pleasure. Thank you.
Thanks. Great stuff. I think that was really insightful. Once again, thank you, Ryan. I'm just going to put up the call to action or the book the meeting. Let's see if you guys can see it. If you can't see it, I'm going to enable the chat and just put the link there. And if you would like to schedule a meeting with your advisor, or just have a chat on how much exposure you might have to Fairtree equity and that, hit that link, set up an appointment. We are here to help you. Once again, thanks for joining us. Look out for the invite next week, Tuesday, same place, same time. And we've got a really nice presentation coming up next week, Tuesday. And Thursday night, we've got the income protected benefit. So invite your friends. Anyone that's got an income protected benefit in their portfolio should listen to this. It's going to be very insightful from one of our directors and specialists, Chris Swanepoel. Thank you for joining. And yeah, it's good to have you guys, and be safe. And if there's questions, chat to us.